Very important corporate voice to a very important market voice. Kenneth Andrade, founder and chief investment officer at Old Bridge Mutual Fund, joins in right now with his thoughts. Kenneth, so good talking to you, as you know, always. Thanks for taking the time out. How constructive slash neutral slash non-constructive are you at the current juncture, considering that a lot has happened in the last, 45 odd days, right? This GST 2.0, geopolitics, then the shifts thereof, maybe the thawing of the relationship as well between India and US, as well as the Fed rate cut that has come in.
Well, yes, everything seems to be falling in place. Okay, let's put it this way, valuations are much better than they were last year. The second part of it is, I think whatever has to happen on the international front has happened. You can't get more uncompetitive than you already are, right? In the domestic environment, you got a liquidity push, plus you got a GST rate cut that has happened. That will stimulate domestic demand and hold the economy for a while at this point in time. And as you know, we've been waiting for a market to consolidate itself, and it is consolidating. So I think the worst is already the worst is already out there. Within the prices, some element of stocks will correct themselves, but largely the time correction has begun, or we're somewhere through that process. And I think a lot of corporates in India will now try and figure out a way how to build their business models in the new regime of things, So this is a place to be. This is probably a right place to be, a right place to look for companies and business models that can take the new environment and actually build significantly on that right now.
Kenneth, would global flows, both FII and FDI investments, be a necessary condition for further upticks here from a market-wide perspective? Or do you reckon individual themes, etc., could continue doing well on the back of domestic flows?
Okay. So the latter is quite easy to answer, because when you talk about domestic thematics that are there, or if you talk about thematics in the market, we've seen some overriding structures over the last couple of decades that the market's been around. We had the tech boom and bust. We had the infrastructure cycle that went through a boom and bust cycle. You see consumers struggling at this point in time, and the lending institutions haven't given you significant amount of returns on a 3 to 5 year standpoint. And that was after they had got a decade of outperformances over the market. So those are the three broad trends that were there. Where we stand at this point in time is also to pick up something pick up an environment which will grow into a significantly large profit pool. I think that already exists somewhere, and we just have to recalibrate our entire investing style and pick those thematics that are there to build it out. Now, when talking about that, which part of the market is the cheapest, given the fact that the market trades somewhere around 20-21 times earnings forward? Okay, wherever there is negative news, or whether there is a slowdown of earnings growth, that's a place uh, where the growth valuations actually go out, they step out, and those businesses become reasonably valuable. Out there, you will get a bunch of entrepreneurs who are working with their costs and waiting for the cycle to kick back. So you gotta figure out where this opportunity lies, and allocate capital to this environment. Quite clearly, India is always going to be a growth market, at least for a while. You're going through a consolidation phase at this point in time. You've got to keep looking for an opportunity to find those companies that are generating cash flows, because generative cash flows becomes growth capital in the next cycle. Okay, so that's where we stand. So domestic cyclicals, domestic consumer businesses that have got the cash flows and are investing in new markets or in new products. That's essentially where you need to head towards. Optimistically, you've got a cash flow cycle in the commodity space, which is very robust. You got a cash flow cycle that is running with the pharmaceutical business, which is very robust.
Right.
IT is also there, which is a very robust cash flow cycle, but now you've got the investment opportunity out there. So there's a whole host of businesses out there that are putting money to work. I think we need to step out and find some of these.
Right. Kenneth, morning. Hiral on this side as well. Last time when we spoke to you as well, a couple of months ago, you had expected earnings growth to be in high single digits. Right now, we are talking about, GST cuts. You're talking about tariffs. You're talking about H1B because you're seeing that correction that's happening in IT right now. Everything said and done, are you seeing any shift happening with regards to where earnings estimates are concerned with the boost that could be coming in with regards to consumption? But on the other side, there is a possibility that your capex cycle would be slightly lower in case your collections are not at par with what is anticipated. The numbers are yet to come in. I think by December is when we should know. But how do you expect an investor to play this dichotomy right now?
I think from a macro standpoint or from a corporate sector standpoint, I don't. I mean, there will be push and pulls within the sector itself. So I don't really think that single digit number on earnings growth is going to materially change. Okay, but while saying this, you will not see a significant sell down in equities despite the fact that you're at single digit growth in earnings, simply because um, the underlying profitability matrix and the underlying corporate balance sheet is got enormous amount of strength. They can invest in growth, and they have the capability to invest in growth. It's just that the fact that where is the growth opportunities that are visible, and I think that's what's holding corporate India back. Growth opportunities with pricing, with an element of capital efficiency, high capital efficiency, what India is looking at. So I think that's where we are stuck with. So growth will come back because you've got the cash flows. Markets won't sell down. I mean, you're not going to get a market which is like 17. Probably you won't get a market with 17 and 18 times in the current environment. But yes, we will struggle with a couple of sectors as they go through this transition. Obviously, IT in the medium term, right now it's sentimentally very negative. In the medium term, you could see a tick down in terms of margins, but they will find their way of building out of it, and we can see that happen with a lot of companies actually issuing statements, and the commentary is not very bearish. Consumers, this is a quarter that you will see a significant pickup of volumes. Pricing, I'm not too sure if there is going to be there, but that volumes itself should hold up numbers for the remainder part of this year. So there's a little bit of everything. We're sitting. I don't think it's a market to be very active at this point in time. You just have to digest the data that comes through, and take a call as you come towards the end of the financial year.
Kenneth, Neeraj and I were just quickly discussing your strong views with regards to where IT as a sector. You are seeing a correction today. You mentioned about a lot of clarifications and commentary that has come in from corporates as well. What would you advise investors to do? Would you tell them this is an opportunity to look at IT if you're not seeing a major long-term impact? Or would you say stay on the sidelines?
So, I mean, inaction is better than action at this point in time. Okay, and there are points in time in your investing journey where sitting quiet is the best thing that you should do, and I think that's the time now. Either which ways, it's left to businesses and business models to define as to how they want to build it forward. Capital with these companies are never an issue, so keep them in your portfolio because they got the financial strength to ride this out. Keep them in the portfolio because they've been through multiple cycles where they've come through stronger. I wouldn't want to rush just because there's a correction and build on it, simply because you can't build a business model with this kind of uncertainty. At least from an investor perspective, I can't see how individual companies will go out and build this business model. So there will be companies that will do it, but as an individual investor, I can't see which one is going to do it and build it out successfully. That will take a couple of quarters to figure it out. So I think that's where we are in our thought process on how to approach IT services companies.
you.